August 5th, 2024. You wake up, check your phone, and the entire global financial system is on fire. Japan's stock market just had its worst day since 1929, worse than 2008. The Nasdaq lost $1 trillion before lunch. Bitcoin crashed 20% in minutes. And if you looked at the headlines, they're all screaming about jobs data or AI bubbles or whatever easy explanation makes people click. But they're lying to you, or they're just stupid. Because what happened that day wasn't about any of that. It was about something way more dangerous. Something that's been quietly building for 30 years. Something that could make 2008 look like a practice run. This is the story of the yen carry trade. And if you don't understand what that means, you're about to. Because this invisible machine has been pumping up every asset you own. Your house, your 401k, your crypto portfolio, everything. And now it's breaking. And when it fully breaks, fortunes will be destroyed and transferred in a matter of days. So first, you need to understand what the hell a carry trade even is. Because this is one of those things that sounds complicated, but it's actually stupidly simple. And once you get it, you'll see why this is the biggest financial time bomb on the planet. Here's how it works. For the last 30 years, Japan has had basically zero interest rates. Sometimes even negative. Why? Because their economy has been in the toilet since 1990. Their population is shrinking. Nobody's having kids. Nobody's spending money. So the Bank of Japan, their version of the Federal Reserve, has been trying desperately to keep things alive by making borrowing free. 0% interest. Free money. If you're a bank or a hedge fund in Japan, you can borrow billions of yen for literally nothing. No cost. Just take it. Now imagine you're a Wall Street hedge fund manager sitting in New York. You see this free money tap in Japan. And you see that in America, you can invest that money and earn 5%, 10%, even 20% returns. US Treasury bonds pay 5%. Nvidia stock goes up 100% a year. Real estate, private equity, all of it pays way more than zero. So what do? You borrow a ton of yen at 0%. You immediately convert it to dollars. You invest those dollars in American assets. And you pocket the difference. Borrow at 0, earn at 5. That's free money. That's the carry trade. And here's the kicker. Because everyone in the world was doing this, borrowing yen and buying dollars, the yen kept getting weaker and weaker. It went from 100 yen to the dollar all the way down to 160, which means the debt you borrowed kept shrinking in dollar terms. You borrowed money, and the debt literally got smaller while you held it. It was perfect. It was infinite free money. And the entire global financial system became addicted to it. Estimates say this trade is worth about $20 trillion. That's the size of the entire US economy. $20 trillion of borrowed Japanese money floating around the world, inflating asset prices, making everyone feel rich. Your house went up in value? Thank Japan. Your stocks went up? Thank Japan. Bitcoin hit $60,000? Thank Japan. All of it was pumped up by this ocean of free Japanese cash. But there's one rule in finance that never changes. There's no such thing as free money. There's always a cost. And the cost here is currency risk. You're betting that the yen stays weak forever. You're betting that Japan never fights back. And on July 31st, 2024, Japan fought back. And the trap snapped shut. For 30 years, betting against Japan was called the Widowmaker trade. Everyone who bet that Japanese interest rates would go up lost everything. Japan was committed to zero rates forever. So why did they change? Why did they suddenly raise rates and blow up the whole system? Because they were dying. For 3 decades, Japan kept the yen weak to help their exporters. Companies like Toyota and Sony. But in 2022, global inflation hit. And because the yen was so weak, importing oil and food became insanely expensive. Japan imports almost everything. Oil, food, everything. And suddenly, regular Japanese people were getting crushed. Their wages stayed flat, but the cost of rice and gas went through the roof. Because they were dying. For 3 decades, Japan kept the yen weak to help their exporters. Companies like Toyota and Sony. But in 2022, global inflation hit. And because the yen was so weak, importing oil and food became insanely expensive. Japan imports almost everything. Oil, food, everything. And suddenly, regular Japanese people were getting crushed. Their wages stayed flat, but the cost of rice and gas went through the roof. Because they were dying. For 3 decades, Japan kept the yen weak to help their exporters. Companies like Toyota and Sony. But in 2022, global inflation hit. And because the yen was so weak, importing oil and food became insanely expensive. Japan imports almost everything. Oil, food, everything. And suddenly, regular Japanese people were getting crushed. Their wages stayed flat, but the cost of rice and gas went through the roof. The Japanese government's approval rating collapsed. People were pissed, and the Bank of Japan had to make a choice. Keep rates at 0 to protect Wall Street's carry trade and watch their own people starve? Or raise rates, defend the yen, and blow up the global financial system? The Japanese government's approval rating collapsed. People were pissed, and the Bank of Japan had to make a choice. Keep rates at 0 to protect Wall Street's carry trade and watch their own people starve? Or raise rates, defend the yen, and blow up the global financial system? They chose their own people. On July 31st, they raised rates to 0.25%, a tiny increase, but it was enough. Because that tiny move triggered a $20 trillion margin call. Before we keep going, if you're starting to see how deep this rabbit hole goes, hit that subscribe button right now. We're Money Trap, and every week we're breaking down the systems that control your money, your life, and your future. This isn't surface-level news. This is the real game. The stuff they don't want you to understand. So subscribe. Turn on notifications, because what comes next is going to blow your mind. Alright, let's keep going. So what happened on August 5th? Why did everything crash at once? Let me break down the math, because this is where it gets brutal. Let's say you're a hedge fund. You borrowed 100 million yen when the exchange rate was 160 yen to the dollar. But then Japan raises rates, and the yen strengthens. It goes from 160 to 140. Suddenly, to pay back that same 100 million loan, you don't need $625,000 anymore. Now multiply that by billions, by trillions. Every hedge fund, every bank, every algorithm doing this trade just saw their debt explode. And here's the problem. They don't have the cash. Their cash is invested. It's in stocks. It's in bonds. It's in crypto. It's all tied up. So what do? They sell everything. They don't sell because they think Nvidia is bad. They sell because they need cash right now to pay back the yen loans. This is forced selling, and it's price agnostic. They hit the sell button at any price. That's why on August 5th, everything crashed together. Stocks, bonds, gold, crypto, everything. In a normal crash, when stocks go down, safe assets like gold go up. But in a liquidity crisis, in a margin call event, everything gets sold, because everyone needs cash at the same time. This wasn't about the US economy. This wasn't about jobs data. This was about the plumbing of the financial system breaking. The leverage was unwinding. The 30-year free money party was ending. And here's the scary part. The media told you it's over. The market bounced back, right? Everything's fine now. That's the most dangerous lie being told. Because according to analysts at JP and other major banks, only about 50% of the carry trade has unwound. That means there are still trillions of dollars of this leveraged bet sitting out there, waiting for the next yen spike to explode. This isn't over. This is halftime. Now let me tell you about the whale, the biggest player in this game that nobody's talking about. It's called Norinchukin Bank. You've probably never heard of them, but they manage over $400 billion in assets. They're the bank for Japanese farmers and fishermen, regular people. And for years, they've been gambling that money in American and European debt. Why? Because interest rates in Japan were zero. They needed to earn something. So they bought hundreds of billions of dollars of risky corporate loans and bonds. But here's the catch. When a Japanese bank buys US assets, they have to hedge the currency risk. They have to buy insurance in case the dollar falls against the yen. Normally, that insurance is cheap. But as the Fed raised US interest rates to 5%, the cost of that hedge exploded. It became so expensive that it ate up all the profits. Norinchukin was losing money just holding US bonds. So in June 2024, right before the crash, they announced they're selling $63 billion of US and European debt, a fire sale, to cover their losses. Think about that. A conservative Japanese bank is dumping $63 billion of Western government bonds, not because they want to, because they have to. And when a whale like that sells, it drains liquidity from the market. It pushes prices down, which causes more losses for other banks, which causes more selling. It's a doom loop. Norinchukin is the canary in the coal mine. If they're bleeding, everyone's bleeding. And we've seen this movie before. 1998, a hedge fund called Long-Term Capital Management, run by Nobel Prize winners and Wall Street legends. They were doing the same carry trade, borrowing cheap in Japan, investing high yield elsewhere. They were leveraged 100 to 1. They controlled over $1 trillion with only $4 billion in equity. And in August 1998, Russia defaulted on its debt. Investors panicked and rushed to safety. They bought yen. The yen exploded in value. In 3 days, it rose 13% against the dollar. For LTCM, that was the end. Their debt in yen exploded while their assets crashed. The math broke. The Federal Reserve had to organize a bailout to prevent them from taking down the entire global financial system. That was one hedge fund. Today, the carry trade is the entire market. It's every bank, every algorithm, every pension fund. The leverage now is exponentially higher than 1998. And if the yen keeps strengthening, the losses won't be in the billions. They'll be in the trillions. Now let's talk about Bitcoin. Because Bitcoin crashed harder than anything on August 5th. It fell 20% while the S&P fell 4%. And people were confused. Bitcoin is supposed to be the safe haven, right? The anti-system asset? So why did it crash with everything else? Because right now, Bitcoin is trading as the world's most sensitive liquidity gauge. It has a 0.94 correlation with global money supply. That means it moves almost perfectly in sync with how much cash and credit is in the system. Hedge funds didn't just use free yen to buy safe bonds. They used it to buy the riskiest, highest return assets they could find, crypto. And when the margin call hit, they had to sell their most liquid assets first. The stock market was closed Sunday night when the panic started. bonds were closed. But crypto trades 24/7. So Bitcoin became the ATM. Traders sold Bitcoin to raise cash before the stock market even opened Monday morning. They weren't selling because they lost faith in Bitcoin. They were selling because they needed liquidity. This proves Bitcoin is currently a risk-on asset. It's the canary. If you want to know if the carry trade unwind is still happening, don't watch the Dow. Watch Bitcoin. Watch the yen-dollar chart. If the yen strengthens and Bitcoin dumps, the unwind is still active. So how does this end? Jerome Powell and the Fed are trapped. They wanted to keep interest rates high to fight inflation. But high US rates are exactly what's breaking the yen carry trade. The gap between US 5.5% and Japan 0.25% is too wide. The pressure is too intense. If the Fed keeps rates high, Japan keeps selling US bonds. US yields spike. Mortgage rates hit 8%. The banking system, which is sitting on hundreds of billions of unrealized losses, starts collapsing. We get a financial crisis worse than 2008, so the Fed has to cut rates. Not because the economy is great, because the financial system is breaking. They have to cut to weaken the dollar and relieve pressure on the yen. But here's the problem. If they cut rates while inflation is still high, inflation comes roaring back. We enter stagflation. High prices, low growth, the 1970s all over again. And if the bond market rebels, if investors refuse to buy US debt because yields are too low, the Fed will have to do the nuclear option. Yield curve control. That is when the central bank prints infinite money to buy its own government debt to keep interest rates artificially low. Japan did it for a decade. Now the US might have to. When that happens, the currency is sacrificed to save the bond market. The dollar devalues. Money supply explodes. And that's when hard assets decouple from paper assets. That's when gold, silver, and Bitcoin stop trading like risky bets and start trading like insurance. Insurance against the debasement of the dollar. This yen situation isn't a one-day event. It's a regime change. We're moving from a world of cheap leverage and easy money to a world of volatility and scarcity. So what do smart investors do now? They use what's called the barbell strategy. You avoid the middle, the stuff that's vulnerable to inflation and crashes, and you focus on two extremes. One end, maximum safety. Cash. Short-term treasury bills that pay 5% and are liquid. This is your dry powder, your oxygen. When the next crash hits, you want cash to buy assets on sale. The other end, maximum hard value. Assets that can't be printed. Gold, silver, Bitcoin. These protect against the endgame, the debasement of currency. What do you avoid? The middle. High debt, margin, speculative junk with no earnings. In a world where liquidity is drying up, leverage is your enemy. Warren Buffett is sitting on $325 billion in cash right now. He's not timing the market. He's waiting for the fire sale. When the carry trade fully unwinds, world-class assets will be on sale. And he wants to be the only one with cash to buy them. Look, we started this talking about a random day in August when markets crashed. But this is way bigger. This is about the end of a 30-year financial regime. The free money era is over. The carry trade, the invisible machine that inflated everything you own, is breaking. And when it fully breaks, wealth will be destroyed and transferred on a scale we haven't seen in decades. The chart you need to watch is USD JPY, dollar versus yen. If that line goes down, yen gets stronger. Danger is rising. If it goes up, yen gets weaker. The bubble inflates a little longer. But either way, the pressure is building. And something has to give. Look, there's so much more to this. How central banks are trapped. Why this could trigger the next global financial crisis. What you should actually do with your money right now. That video is up next on your screen. Watch it, because understanding this isn't optional anymore. This is happening right now. And the people who see it coming will be the ones who survive. Drop a comment. Do you think the Fed will save the dollar or save the market? Let me know. I read every single one. Until next time, stay sharp.